Good afternoon. Uh, I'm Delegate Maggie McIntosh, Chair of the Appropriations Committee, and we are here today with the Senate Budget and Tax Committee on a briefing on an agency budget analysis of two agencies. One, we want to talk about public debt today, and also the State Reserve Fund. We are going to have with us as we go through this briefing the Honorable Nancy Kopp, our Treasurer of the State of Maryland, and her team, and also the Honorable David Brinkley, who is the Secretary of the Budget Department of Budget and Management, and his team. Before we begin with our analysts, I'd like to first again welcome the Senate Budget and Tax Committee and their chair, Delegate Guy Gazzoni, for any remarks that you would like to make.
Once a delegate, always a delegate, Madam Chair. Yes, many happy days with the Appropriations Committee.
I gave you a promotion. I'm sorry.
You did.
All right. But you're right. Once a delegate, always a delegate, but also a fine senator, I might add, you know?
Thank you.
We are very pleased that we trained you in the House, okay?
That's right. Yeah. That's right. So happy to be with you, ready to get rolling.
Okay. All right. Well, let's call Patrick Franco, okay?
Awesome.
Hello, does everyone see my screen?
Yes.
Okay, great. All right, this first analysis is the public debt. What this basically is the bond proceeds that pay for the state's capital program. The sources of revenues that pay this are primarily the state property tax, but there's also some general funds and some other revenues associated with it. I'm going to show you it's about $1.3 to $1.4 billion over the next few years, and there's more about that later as we go through the analysis. The first thing I want to talk about is we're going to go right into something complicated. The way our bonds are issued lately have been that they have been selling at a premium. What that essentially means is the interest rate is the same whether bonds sell at a premium or not. The difference is that you're getting more money up front and therefore you're paying more debt service costs later. There are some questions about how to manage this, which we'll get to it towards the end of the analysis, but there is a BRF item which suggests that some of this money be used for some capital projects from fiscal 2021 to 2023. There also has been a change in the way the premiums have been interpreted by our bond counsel. Essentially what they've done is they've set a limit of what they call the capitalized interest, which is the first 3 years of interest only payments. And so that is a cap on how much we could use for our debt service payments. And we'll talk more about that later. Just wanted to make you aware there's this BRF provision. First chart I have for you, I think is very helpful in that this shows the principal, the interest, and there's a small amount that goes into sinking funds. The sinking funds pays for special tax credit bonds that the feds allow us to do, which are basically just a cheap way of financing. The reason this green part, the principal, is so large is because the state bonds are limited to 15 years. And what that means, it sounds like a long time, but it means we pay off our debt very quickly. So we tend to have less interest payments, and there will be more about that later. Here is the fiscal year 22 total debt service costs. I guess if there's one takeaway from this, is you see this number here, $1,351 million. That is from debt that has already been issued in prior years. So that's essentially a fixed amount. Even if there were no capital program and no more debt issued, that's how much you're paying. What we anticipate, though, in fiscal 2021 are some bond sales that will affect that number. You can see them here. The March sale, I guess it'll be late February, and then early March is when closing is, and then the summer sale. And those are, we expect another $37 million in interest costs from those two to bring the total to $1,388.5 million in debt service costs in fiscal 2022. This chart here shows the basically the revenues that are paying for this debt service over the next few years. As I mentioned earlier, property tax is the big one. You can see that here. That's about 2/3 of the cost. There's also some premiums, which is fairly substantial, that we're using to pay our debt service. And good news is we have expect a $25.5 million fund balance at the end of fiscal 2022. Since property taxes are such a large part of paying for these bonds, we take a look at what's happening in the housing market. This is since January 2005. This is a 12-month moving average in order to even out the seasonality, because home prices tend to appreciate in the summer months and relatively depreciate in the winter months. And what's amazing about this in the recent year is if you look at this purple line, that shows the active inventory that's out there. This data is from the Maryland Association of Realtors. And so it looks like if you think if you're looking for a house and you're having a tough time finding it, well, the data suggests that it's quite a drop it's been. These lines, as you might expect, often go in opposite directions. If there's less inventory, values often appreciate, and that's what's happened lately as well. Let's see, what do we expect debt service costs to be and the property tax to be over the next 5-6 years? Here's the forecast. The green bars are the debt service costs, and the yellow orange is what we expect the state property tax receipts to be. So there is a gap there, and that's because that is on purpose. The state does not want to raise the state property tax any, and so we've made a conscious decision to use general funds in order to keep those rates down. And from that, we have a 6-year forecast that projects what the costs will be. And the bar is the general funds, which is a number that I know this committee is very interested in. As you can see here, there are some large premiums that we anticipate in the next few years, and we're using those to pay down our debt service costs now to keep the general fund subsidy lower. That does mean we do pay higher debt service costs in the out years, but in the short term, there's definitely a gain there. As you all know, there has been a pandemic, and what this Exhibit 8 does is it takes a look at how bond markets have been affected by this pandemic. And it's kind of fascinating, actually. If you look at these first few months of the pandemic, the green line here is state and local interest rate cost. This is an index that I like to use from the bond buyer. And you can see the volatility. People really did not know what was going on in the month of March, because these bonds are fairly safe instruments, and you don't tend to see a lot of volatility in them on their own. If something is going on, even if I didn't know there was a pandemic, I would be very surprised to see this. I also added the yellow line, which is the 10-year Treasury note. I picked the 10-year Treasury note because that's the average maturity of our own bonds. And that's kind of like in finance, the kind of the floor is how low you can go. Because generally, since the federal government is considered to be the safest institution, you wouldn't expect your rates to go below that. And as you can see here, we've had some very successful bond sales since the beginning of the pandemic. The first one, it looks like we got in just in time before the pandemic became interesting, if you will. And the other one in July was also at a time in which the rates were very low. And so we've had some success. Also, in the July sale, we did something interesting. Usually when we do a refunding, what we do is we just take the savings and the refunding bonds that we sell, we have maturities that are about the same as the bonds that were refunded. So what you have is a fairly stable income stream, and then in a number of years see a decline in debt service costs. This year in July, there was concern about short-term cash flow. And so instead, what the State Treasurer's Office did is pretty much it took all of the savings, as you can see, in 2021. So they took, so as you see, $61 million was now. What that meant was there's going to be no savings in the out years. Now, this is admittedly a little bit less efficient than if it were done as we normally do it. But if you need cash, this is a very efficient way to raise that cash quickly. And that's essentially what the State Treasury did with this. All right. So one of the things that's important in Maryland, as you all know, is the Capital Debt Affordability Committee that sets a limit on the annual GO bond authorizations. What this table here shows is one of the ratios, which is the debt service to revenues ratio. Our limit is 8%. And as you can see, we are below that limit. So there certainly is some capacity. And this also shows the major sources of debt service. The largest, of course, is the general obligation bonds. But MDOT's bonds are also considered to be state debt, so they're part of the calculation. Also, there are some stadium authority bonds, the Bay Restoration bonds, and some of the capital leases are also considered to be state debt. So we are well below, I'm not well below, but comfortably enough below that we do have some capacity. But I would say that it's, if there were a sharp decline in revenues, then we were concerned if 6 months ago that we might breach this ratio because of it turns out the revenues bounced back somewhat, and so we're in much better shape now. The second ratio that we have is that debt outstanding is no more than 4% of state personal income. And this is declining steadily, this ratio. And part of the reason is in the last 5, 6, 7 years even, the state has been limiting the growth in the GO program by about 1% a year. And so we've really, by limiting it, it's really slowed the growth in this program. And since the personal income and some of these other ratios are growing faster than the revenues and personal income are growing faster than 1%. This has given us some capacity because we were quite close to the capacity after the Great Recession. Another thing I like to do is like to compare how do these ratios that we have compare to what's happening in other AAA rated states. And what you can see, the conclusion is Maryland is definitely a high debt state. We're 14th among all states, and only Delaware has a higher ratio of debt outstanding to personal income. And the mean is about 2.6%. We're about 3.5% in 2019, as Moody's calculated it. Similarly, in debt service, we are the highest of the AAA rated states. And it's you can kind of see here when I was talking earlier about the pie chart that showed how much principal we pay. Well, if these kind of two charts really show that very well. Because we have short maturities, we retire our debt early. So the debt outstanding ratio we do pretty well in. The flip side of that is if you're going to pay extra debt service to retire your debt early, you're going to tend to have higher debt service payments. And so that's what these, in combinations, that's what it shows how this policy of having relatively short-term debt is, it clears up, gets it off of our books pretty quickly, but on the other hand, we're paying a little more now. And so the question then becomes, why are we a high debt state and what are we doing with the money? And Exhibit 14, I think, shows this pretty well, is about 15% of the budget as introduced that we'll be working on this session is for state facilities, 26% is the state universities, and 59% is other non-state programs like the school construction and all these things. And so what we've decided as a state is that we will provide other non-state institutions much more capital funding than other states are doing, and that is why we are where we are. There are some other issues to also be aware of, and that is there have been recently some large non-state debt authorizations. The determination is made that the lottery and the education trust fund proceeds are not state revenue, so that's why we don't consider it state debt. This chart may be dated a little bit because there may have there may be some consideration of the school construction program. But basically, we are putting a lot of money into these other programs as well for state support. Also, I'd like to mention here, Exhibit 16, we do have some unfunded liabilities with the pension and Opeb, that's the retired employee health insurance. We are up to 73% on the funded ratio, and we put about $2 billion a year into those programs. Maryland is a AAA rated state, even though we are a high debt state, and there are some good reasons for that. One reason is that we're a wealthy state and we have high income levels. So we can support a lot. We have a broad and diverse economy. And finally, I think most importantly, we have well-managed and what they call well-embedded financial practices, things like the Capital Debt Affordability Committee that for now 5, 6, 7 years has limited the growth in the GEO program to 1%. That shows we are able to make some decisions and stick with them. And so our strong financial practices have been commended by the rating agencies. Also, the markets have treated our debt very well. I did an analysis over the interim using the sum of least squares regression to compare our interest rates to some other kinds of indices. And basically that index I showed you earlier today, we're about 85% of that index. So we're 15% less than a general index of state and municipal debt, which is a pretty good thing. And also what I've noticed is since the Great Recession, there's been something called a flight to quality. And that's also reduced our interest rates by quite a bit. Before the Great Recession, people were less concerned about credit quality apparently, but now they are more concerned, and that's been the state has benefited from that. And so my conclusions from that analysis are that most AAA states do have debt levels below the median, but because of our strong affordability process, we do still get the benefit of having the high AAA rating. And really, in conclusion, process really matters a lot with how we manage our program. And I would encourage us to continue these good practices. The final issue I'm going to talk about has to do with the Joint Chairman's report that was done. It was worked on by our department, the Department of Budget Management, and the State Treasurer's Office. We looked at some of the issues related to the bond premiums, and I believe there was a general consensus that if possible, there are advantages to resizing some sales, which is to say, in some cases, when the economy is doing well, to reduce the bond proceeds that we get in premiums, and instead reducing out your costs. But there also it is a good tool to have if you are in recession, to be able to have those premiums to help support your debt service. And I've concluded with my recommendation, which is a $2 million reduction to this budget. When I calculated the costs of debt service, I noticed that the number that was used for this current sale was a little bit higher than the actual sale will be. And there was also a slight difference in the summer sale. And so when you took all those things together, there's probably $2 million more for those sales than is necessary for debt service. So I would recommend a $2 million reduction, which for funds that are not needed in the budget. And with that, I conclude my presentation, and I can take questions.
Thank you very much. We'll alternate questions between the House and the Senate, if that's all right with you, Mr. Chairman. And I do have Delegate Kettleman who has a question.
Thank you, Madam Chair. Just the statement that Moody's likes our proactive financial management and that the Board of Public Works is able to respond swiftly to mid-year budget challenges. I believe that's we have a bill that would change that a little bit. And I just wondered if the minor changes being made, it's going to have any impact on the rating agencies.
I'm not sure exactly which bill you're talking about. I did see a bill that made what I clarified. I think as I read it, it clarified the definition of what an appropriation line is, or something along those lines. That didn't. I mean, it pretty much allowed, as I read it, the Board of Public Works a great amount of authority and ability to make changes. And so I would imagine that what I saw didn't probably would not is probably fine. I mean, it seemed like a very limited clarification.
Well, I could be mistaken in this, but the bill I was talking about talked about the administration's recommendations, and they have a 25% level when they bring a change to the Board of Public Works. So would that be an influence?
Well, I should probably look at the bill more closely. I don't want to, but it seems that I think they're having the mechanism is important.
And the mechanism is still there.
Pardon?
I said the mechanism is still there. It's just been modified somewhat.
If you want, I should probably look at it more closely, and if you want, I can get back to you on that.
Thank you.
Thank you. I don't see any senators. We do have Delegate Krim.
Thank you, Madam Chair. Patrick, I didn't see in your analysis other states. You talked about Maryland's term for their bonds are 15 years. What's other states' term? And you say ours is a, low term because it's 15 years.
It's common for 30-year bonds to be sold. So that's quite a bit longer. Also, the 15-year limit is in the state constitution, which could be changed, but that would require a constitutional amendment.
Okay. Any other questions? Okay. We'll bring up our state treasurer, Nancy Kopp. And you can bring along whomever you wish.
Thank you, Madam Chairman. Madam Chairman, Mr. Chairman, members of the committees, it's a pleasure to be with you today. Today is this is a very important week in Annapolis, I know, and that in fact, my chief deputy is not with us today. She's working with the comptroller's office to make sure that when certain legislation is passed and signed, the end of this week, the beginning of next week, the comptroller will be in a position to be able to distribute the funds that he is authorized to distribute. But I do have with me Christian Lund, who many of you know. I believe Christian is the director of state debt, director of debt management for us. And as a matter of fact, it ran essentially the 6-hour marathon that we had yesterday of meetings with the 3 rating agencies, remote meetings with the 3 agencies, and the Department of Budget and Management, the Comptroller's Office, the Treasurer's Office, and the Department of Legislative Services. And we were sitting around a virtual table talking to the 3 major rating agencies. And I will say that I think the meetings went very well. We look forward to receiving the ratings by the end of next week, I believe. Christian, I don't see you, but.
That's correct, yes, by next Wednesday.
And went through many of the issues actually that Mr. Frank has raised. We, I will say on my behalf, on behalf of our office, we agree with Mr. Frank. The premiums issue is one that we tussled over because I, as one of those former members, Madam Chairman of the House Appropriations Committee, would not like to see written into law handcuffs on what the legislature can do with the premium. But there is no doubt that people want to pay premiums because they like our bonds structured the way they are, but it is a significant fiscal savings if you can roll those premiums into either restructuring or capital debt and not just use them for ongoing debt service. But those numbers are numbers, and policy decisions, it seems to me, should be up to the legislature and the governor. So we did sign on to the Joint Chairman's report. We do agree with those priorities. We just urge you not to prohibit your successors from doing something that may be necessary at some point. I think I'm going to turn this over to Christian just to say that we do agree. A major difference between Maryland and our peer states is that we do authorize a significant amount of school construction at the state level. Most states don't do that. So obviously, if you look across the board, you're going to find a lot of other states where local debt might be higher, state debt lower. That again is a policy decision, although some would argue it's also potentially a constitutional mandate. That the state support thorough and efficient education and school construction. I believe it served us well, and the fact that people invest in Maryland when they're flying to quality, I believe indicates that others think so also. Those, I think, were the major issues. And with that, I would like to turn it over to Christian just to make a few comments. I can't shut up without pointing out that not only is this a very important week in Annapolis, but a very important week in our nation's capital as well. And I don't want to keep you away from significant constitutional developments. Thank you.
Especially when a former member of the Senate has a pivotal role.
Yes.
Well, yeah, thank you, Treasurer. I guess just to piggyback off of what the Treasurer said and what Patrick referred to earlier. So there is this BRFA provision that would restrict future legislatures and governors from using bond premium to offset debt service cost or spend it on capital projects. So that BRFA provision exists, but there's also an alternate piece of legislation that Senator Peters and Delegate Chang are sponsoring and that the Treasurer's Office has been working with them on, Senate Bill 60, House Bill 887, which would bring our state requirements on use of bond premium in line with the federal requirements, but still maintain flexibility for future policymakers to use those according to the needs of the state at the time. So, I'd encourage everybody to consider against Senate Bill 60 and House Bill 887 as an alternative to that BRFA provision.
Could I just interrupt to say that the senator and delegate sponsors were in fact the members, your representatives on the Capital Debt Affordability Committee when the bill was filed?
That's right.
Yeah, we did slight Chairman Barnes.
So I guess, I don't want to take up a ton of time, just a really brief municipal bond market update. 2020 was obviously a weird year, just like for the muni market, just like it was for everybody else. There was that period of extreme volatility that Patrick mentioned. I'd point out that, that volatility was in some ways kind of meaningless because there were no deals getting done at the time. The market had totally shut down. Once it came back and once deals started happening, we settled into this period of historically low rates. And when I say historically low, I mean compared to the 2010s, which we always talked about as being historically low. So rates are very, very, very low. I think that's a big takeaway. I think policymakers learned a lot from the financial crisis a decade ago, and we've seen tremendous fiscal response, monetary response, policy response that has really done a good job of containing the fallout from the pandemic to sort of the directly impacted sectors. That's not to imply that aren't people and sectors hurting. There are, but there wasn't like sort of the contagion you saw 10 years ago. Looking ahead to 2021, continued government support is going to be critical, obviously. Mark Zandi, the chief economist at Moody's, said, it's better to err on the side of too much rather than too little. He said, now's the time to push on the fiscal accelerator. And we've seen Washington take that message. I think we're seeing the state take that message too, with the Relief Act and the amendments that the legislature has put on that. And I think those are going to be positive and help the state recover more quickly. But obviously, we're not fully going to recover until the virus is under control. And so, getting the virus under control is going to be critical to making sure that the markets still function and that we can still do the things we need to do moving forward. I think, it's tough to predict where interest rates are going to go, but there is something I want to bring up, which is just this major break with precedent that the Federal Reserve is making, where, in the past, they had this target of 2% inflation every year. And, in the past, as soon as they saw us start to approach 2%, they would pump the brakes. Now, a lot of people have said that they were pumping the brakes prematurely because over the last decade, we never actually got up to that 2% target. We stayed underneath it the whole time. So now they have been very clear and consistent for several months that they're going to let the economy run hot. They're going to let inflation go above that 2% rate so that they achieve an average of 2% inflation over a period of time. Now, that means some things for the municipal bond market. One is, Fed rates and muni rates aren't linked on a one-to-one basis, right? But if the Fed has rates at 0, then you can expect muni rates to remain very, very low. And all of the market data, everything investors are telling us is that they don't expect inflation to go up to that 2% level for at least a year, 2 years, maybe longer. So all that sort of comes together to tell us that we think muni rates are going to remain very low for at least the next year or so, and it could be longer than that. And that means it's a great opportunity to address capital needs. You know, we can issue debt at historically low rates, especially on that short end of the curve, which is where we operate because we have that 15-year limit on debt. And anything that we do to address our capital needs also stimulates the economy here in the state as we sort of start to head into this recovery. So that's the bond market update, sort of brief overview. I'm happy to answer questions. I don't think there's anything else I'd cover other than I do just want to point out, you know, the last part of our written testimony, which you have in front of us there, is that there's a large amount of untapped capacity under the CDAC guidelines. As Patrick mentioned, new bond authorizations have been held below the rate of inflation for the last several years. And during that time, revenues and personal income have continued to grow, notwithstanding the pandemic. And that means that those CDAC guidelines, whereas, you know, in the past, we've been almost breaching those and in danger of breaching those, right now, there's a lot of capacity. So it is a good time to make those capital improvements, and there is capacity under the CDAC guidelines to do that. That said, there are always trade-offs, and I know that it's the governor and the legislature's job to determine what the proper balance of those trade-offs are. So just pointing that out. I think that concludes my remarks. I'm happy to take questions.
Good. Well, you were singing out of the same hymnal I sing out when it comes to the importance of a strong capital budget in times like these. I thank you for that. Delegate Haynes.
Well, Madam Chair, I guess I'm in the same choir because I was going to ask a question about, you know, historically, it's always a good time when we're in situations like this to have a strong capital project program, as it is an impetus, you know, for fueling the economy. My other question, though, was my sort of annual question to the treasurer regarding the AAA bond rating. And it seems to me that we all know that we work very hard in the state of Maryland to make sure that we maintain our coveted AAA bond rating. With all that's going on with the pandemic, where we are physically in the state of Maryland, and I know the rainy day fund has taken some hits, but there, from what I'm hearing and my understanding, that seems to be no concerns at this juncture from the rating companies as it relates to the AAA bond rating that we have here in Maryland, correct?
Well, we'll know next week, but I would say that they have endorsed, thus far at least, the way Maryland approaches the use of debt. And they are aware that capital plants also wear out. And the fact that you're turning your attention to maintenance and to investment in sustainability and the sustainable infrastructure is of significance to them.
Very good. Good.
Thank you, Madam Chair. Thank you, Treasurer.
Welcome. Do we have any questions on the Senate side? Chairman, I don't see any, so I think we're ready to move on our agenda today. Yes, go ahead.
I would just normally say I'm right across the street if we can give you any more information. We're right at the end of these wires, however they work. Thank you.
The wires. Well, thank you very much. And, you know, thank you, Patrick, for your presentation. We're now.
If it's all right with you, Madam Chairman, Mr. Chairman, I'll stay for the reserve.
Absolutely. Absolutely, you're welcome.
Thank you.
We allow former delegates, you know, in this meeting today. All right. And always. It's always a pleasure. We're now going to move to the State Reserve Fund. Rebecca Ruff.
Good afternoon. I hope you're all doing well.
We are.
I'm going to attempt to share my screen. So hopefully you can all see the cover page of the Reserve Fund analysis for fiscal 2022.
We see it.
Wonderful. So this is our standard cover page chart, which gives you a glimpse into the appropriation for the reserve fund accounts for fiscal 2020 through the 2022 allowance. And the real takeaway in looking at this chart is that there's about $104 million appropriated in total to the accounts this year. But what you see is that the reserve fund accounts, the rainy day fund, the dedicated purpose account primarily, are being utilized in fiscal 2021 and 2022 in order to help balance the general fund. And so this chart is a summary of the activity in the 3 reserve fund accounts that are analyzed in this document for you. And what this exhibit serves the purpose of is it's in lieu of the standard where it goes chart explanation that you see in most other analysis documents. So I'm going to talk in a little bit more detail about the activity that has occurred within the rainy day fund in just a minute. And so what I'd like to use this particular exhibit for is to give you the details of what's been going on with the dedicated purpose account specifically, which is this middle column of numbers. And the real takeaways with that is that the dedicated purpose account was part of the cost containment actions that the governor and the Board of Public Works implemented, both in May of 2020 and then again in July of this past year as well. So at the May Board of Public Works meeting, there was a reduction of $97 million that was in the dedicated purpose account. And this was $62 million in funding for legislative priorities that the governor wasn't planning to release. And then also the remainder of the funding was a reduction to the WMATA capital grant. In the July cost containment actions, their total reduction was $38 million. And this was $10 million that had been appropriated for cybersecurity assessments for state agencies. And then also another reduction to the WMATA grant, totaling $28 million. In terms of the appropriation to the dedicated purpose account for the budget that you all are considering, there's a total of $93.9 million provided as an appropriation to the fund. However, the BRFA removes all of those appropriations. There are 3 statutorily mandated appropriations. It's $25 million to the pension fund to offset unfunded liabilities, another $25 million to offset the liabilities for the Opeb, and then also $0.9 million in POS repayment funds. And again, there are separate provisions in the BRFA to implement these contingent reductions, leaving a $0 balance and basically eliminating the entire appropriation and sending those funds instead to general fund revenues. With regard to the catastrophic event account, there is essentially no activity. There are no appropriations. There is no spending out of this account. In fact, the last activity we saw was the return of just under $1 million to the account in fiscal 2020. And these are repayments from loans that were provided to businesses in Ellicott City as a result of the flooding disasters that occurred a few years ago. I would just note that those there are still some outstanding balances on those loans, but the determination has been made to defer those repayments at least until later this fall. So with specifically looking at the activity of the rainy day fund, I thought it would be good to provide you all with a little bit of context about where the fund is at, but then also a little bit of history about how the fund has been used over the last couple of decades to help support the general fund and the operations of the state. So what you see in this exhibit is the end of year balances for the rainy day fund going back all the way to fiscal 2000. And the lines here represent the goals essentially that we have for maintaining fund balance in the rainy day fund. Statute requires different appropriations in order to meet certain thresholds. So if the rainy day fund balance were to fall below 3% of general fund revenues, it would require an annual appropriation of $100 million each year. If the balance is below 7.5%, which is the blue bar in this chart, then the required appropriation is $50 million each year. And the statute does dictate, and history suggests that the goal to be working towards is maintaining 7.5% of general fund revenues. But the reason why we have this dotted line, which represents the 5% level, is because that's typically where the recommendation has been, both historically speaking, and the most consistent recommendation of the Spending Affordability Committee. So what you can see from the data in this chart is that in the past 25 years, we've breached our 7.5% goal only twice. And the most recent time being 2007, which then we immediately turned around and entered into the Great Recession and had to withdraw that balance in order to help support the loss of general fund revenues. Over the course of this chart, there have been 10 times where the fund balance has gone below the 5% target. And the most recent time being our projected ending balance for the current fiscal year, fiscal 2021, where we are projecting a closing balance currently of about 4.7% of general fund revenues. And so I believe maybe this chart is still familiar to you all. We presented it during the fiscal briefing. This gives you a track record of the most recent activity in the account, beginning with where you all left the rainy day fund balance when you left last session. And that was at 6% of general fund revenues, or just under $1.2 billion in the account. Since then, the governor has utilized $250 million for the Economic Recovery Initiative that was announced in October. And then also, we're still waiting, but assuming that we will see the transfer of $54 million to the general fund as was part of last session's budget balancing plan. So as I mentioned, this leaves the fiscal 2022 opening fund balance at about 4.7% of general fund revenues. Statute requires an appropriation of $526 million. This is provided in the budget. And if that were to remain, it would bring us up to about 7.1% of revenues, or $1.4 billion in the account. But the BRFA as it stands, as introduced by the governor, does draw that fund balance down to the equivalent of 5% of general fund revenues. And therefore you see a contingent reduction of $422 million and a closing balance of about $991 million. Exhibit 5 gives you an idea of the extent to which we regularly utilize what is essentially the state's savings account in order to help support the operations of the state, or to fund legislative priorities to help boost up the general fund balance. There's only 5 years out of the roughly 25 years pictured in this chart where we didn't access the rainy day fund or divert some portion of the appropriation that should statutorily go to the rainy day fund. In total, this chart indicates that since fiscal 2000, we've in fact diverted about $4.5 billion from the rainy day fund, but we're still looking at a fund balance of just under $1 billion to close fiscal 2022. The other issue that I just briefly wanted to bring to your attention is one that doesn't actually pertain to the reserve fund accounts. It instead pertains to the local income tax reserve account, which there was a provision last year to move the repayment to that account from previously borrowed funds off books and make it a revenue transfer. But there is another provision that pertains to the local income tax reserve account in this year's BRFA, and that is to provide authorization to allow the state to temporarily charge expenditures related to the pandemic against the fund balance that exists in the LITR account until we receive our anticipated reimbursements from FEMA's public assistance program. So between fiscal 2020 and 2021, We're currently anticipating that we have approximately $800 million in funds that we are requesting to receive reimbursement from FEMA. As kind of an accounting practice, I think there's currently a $200 million accrual for fiscal 2020. And so what this provision would allow us to do would be able to utilize some of the fund balance that is sitting in the LITR in order to be able to close out the books for fiscal 2020. And then as we receive the FEMA reimbursement, we would just charge those funds back to the fund balance to keep the LITR whole. And the provision has a timeline on it, but it does allow the same practice to be implemented if necessary in fiscal 2021 as well. So right now, what we have is a fund balance of about $1.5 billion, although there's a little bit of a timing issue with the distributions that make that higher than normal. So a better number to reference might be the closing balance as of the end of November, which was just under $1 billion. And it doesn't seem to be so much of an issue for fiscal 2020 because we did just receive notice that we've been approved for at least $340 million in FEMA reimbursement out of our total $800 million request. But as I said, this is a provision that could potentially apply to fiscal 2021. I believe may go all the way through fiscal 2022, according to the provision in the BRFA. So it's kind of something that is there if needed. There has been some concern expressed about what happens if we do borrow the funds and there's not enough to make the distributions necessary to the local governments. And I would just say in looking at the fund, on average, distributions each month total about $550 million. And there is funds that are constantly coming in and going out. So it doesn't appear to be an immediate concern, but we did ask the controller about that concern. And it was expressed to us that if there were to be some reason why there would be a shortfall, that their approach would be to just take the funds necessary out of the general fund side of the income, knowing that the reimbursements would eventually make their way back to the LITR. In addition, there's been some changes with the rules for requesting FEMA public assistance, where we now think we will be eligible to receive even more federal funds through the public assistance program that we'd already anticipated requesting. So it's possible we won't need this provision at all, but it does definitely serve as a safety net. Recommendation, the only recommendation for the reserve fund analysis is the annual committee narrative that we ask for to have DHCD and DBM submit a report that does identify any repayments made to the catastrophic event account and the small minority and women-owned business accounts until those previous loans are completely repaid. With that is the conclusion of my presentation. Thank you.
Very good, very good. Any questions of the analyst? Delegate Corman.
Thank you, Madam Chair. Thank you, Rebecca. As always, in Exhibit 5, in 2015, the funds were diverted to what looks like some special fund. I'm just curious if you know what that was. The green transfer to other funds.
Yes. Let me. 2015.
You can also just send it to me if that's easier.
Yeah, I have the detail in a very detailed file.
You can just send it to me. That'd be great. If I could ask a follow-up, Madam Chair.
Yes.
Great. So on the local income tax reserve account, I mean, so it seems like they're just using this to front cash. I mean, and then they'll just repay the account later?
Right. So the way the public assistance program works is under the normal rules, the state is on the hook for 25% of the costs, and FEMA reimburses for 75% of eligible costs. But the way it's implemented is that the state forward funds all of the costs and then asks for a reimbursement. So what the provision essentially does is, instead of having to apply general funds to any of those expenses, meaning those general funds can't be spent on other things in the budget, then what it allows them to do is to take the funds out of the LITR to forward fund until we receive the FEMA reimbursement.
Okay.
And then once we get, oh, sorry.
Go ahead.
Once we get the FEMA funds back in the form of reimbursement, they'll just be deposited directly into the LITR in order to make that fund whole again.
Okay, and I don't want you to have to put on your Patrick Frank hat because obviously this is kind of a question for him, but in the past, the bond rating agencies have expressed concern about the use of the LITR, particularly without a repayment plan. Do you think this, since there is a repayment plan in your telling of it, would not raise any issues with them?
Right, so that is my understanding. And the Appendix 2 of the analysis provides a summary of when we've borrowed funds in recent history and whether there's been a repayment plan or not. So there is an outstanding liability of just under $740 million from repayment plans that have been canceled. Although there was a provision, statute was changed in 2018 to make an ongoing revenue transfer of $10 million to help address that unfunded liability. But my overall understanding is that if there is a repayment plan in place, then it doesn't have to be counted as an unfunded liability. And so it's therefore much less of a concern.
Thank you, Rebecca. Thank you, Madam Chair.
Thank you. And by the way, Rebecca, when you get the answer to Delegate Corman's first question, could you share it with us all?
Of course.
Please pique my curiosity.
Yes.
Delegate Haynes.
Thank you very much, Madam Chair. Rebecca, good to see you again. I have a question as relates to the small minority and women-owned business account.
Yes.
There was a diversion from that account dealing with the flooding situation a few years back. And just succinctly, my question is whether the unpaid amount to the fund, which we understand has been deferred to September 2021, but the fact that we are in another catastrophic situation with COVID-19, does that place any stress on the use of the fund for requested usage from those who may qualify under that fund at this point? Would you know that?
I would have to check with our DHCD analyst about the SWMOBA funds themselves.
Okay.
But I can
All
find
right.
out.
Thank you. Thank you, Madam Chair.
Well, do we hear from any senators?
Quiet today.
Yeah. Did you guys stay out late last night or something? I mean, what's going on here?
There's nowhere to go.
Nowhere to go. All right, well, we're going to bring up the Secretary of Budget Management, the Honorable David Brinkley. And thank you, Rebecca, for an excellent report.
Thank you.
Good afternoon, Madam Chair, members of the House, and good afternoon, Mr. Chairman of the Budget and Tax and my colleagues on Budget and Tax from many years ago. And first thing I want to do is acknowledge the work that Rebecca did. She did a great job with this report, and you have about 2 pages of single-space written testimony in front of you from me and my team members. And I really don't have anything to add. We concur with the recommendation. We do see this as something to give some flexibility as we move forward. There may or may not be the necessity to go into it, particularly as we try to digest everything that's happening from Washington and the impact that might be. So, Madam Chair and Mr. Chair, I have nothing really further to add. We included it all in writing.
Here's yet another fine example of what it's like to be trained in the House of Delegates. Another former delegate. Yeah. All right. Any questions from either of us? And Mark doesn't have anything to add? No questions? This is outstanding. We do have one person in the public signed up, by the way, to testify. So I will bring them, if that's okay with everyone, forward now. And that's,
Thank you, Madam Chair.
thank you very much, Mr. Secretary. We'll be looking forward to working with you as we move along. Randy Shank, Maryland School for the Deaf, has signed up to testify on the State Reserve Fund. Is Randy here? I don't see Randy. Does anyone else see? Okay. We'll make sure that we reach out and get any written testimony that Randy might have, and we'll share with both committees. With that, I'm ready to conclude for the day. Mr. Chairman, do you want to close us out?
Sure. Let's adjourn.
Thank you. Have a great
Yep.
day, everybody. Stay healthy and safe.